Different industries are looking at the impact in a different way. And also we saw towards the end of last quarter or maybe middle of last quarter, consumer confidence also, the index went little low in US. So there are, like you said, it's mixed signals. There are certain industries, for instance, our banking financial services still seems to be resilient. Consumer business and auto, there are some worries. Okay, so it's a mixed bag, but we are staying close to our customers and trying to understand what would be the best possible way that we can support them at this juncture.
Right. Last time when we spoke, you said that CY25 will be better than CY24 and CY26 will be even better. Do you stay on your guidance?
First thing, at least if you look at FY25 has been better than FY24. So at least we have delivered on one part of the promise. We still stay confident that FY26 will be better than FY25. See, like if you look at our order book, we announced one of the strongest order books without the support of any mega deals, almost $12.2 billion coming. Our pipeline remains strong. There is a fair bit of discretionary projects in that 12.2. So while I believe these uncertainties will settle sometime soon, and in the medium to long term, our business model is quite resilient.
Right. I want to understand from you, Samir, on margins front, what has been reason for decline sequentially, and how do you see FY26 in terms of margin? Do you see an improvement is possible in coming quarters?
Okay. Our margins our sequential margin was at 24.2%. It has been a decline of 30 basis points. And if I were to walk you through, overall, the major reasons have been investment. We invested into talent in terms of tactical interventions which we did, and we invested into capability building as well as expansion of our infrastructure. And we got towards that we approximately invested about 160 basis points, and that was offset primarily by operating leverage improvements, about 50 basis points, and about 50 to 80, and there was support from currency coming in. So that sums it up.
If I see overall environment, particularly I ask you the question because US is your major contributor. It has declined to 48% if, from the last quarter. Also there is a sequential decline if I see it correctly. How do you see the changing policy environment impacting particularly the deals dilemma?
On a sequential basis, North America grew for us. Okay, there has not been a decline. That's why all major markets grew last quarter. Okay, but overall, see, like you said, the discussions on trade policies, actions, this space has been quite busy, and our customers are also trying to understand how it impacts them. And that's the reason you find some of the customers, particularly in the consumer business or airline, some programs have been paused and some decisions have been delayed. But at the same time, we have not heard any major program getting cancelled. I don't think there is any panic reaction amongst our customer base as well. They are watching this space, and they'll wait for some clarity to emerge over the next few weeks or months.
Sequentially, there is also growth in BFSI. Does it look better than what it was there in Q3? And overall, which are the sectors you see will be the levers of growth?
BFSI definitely is looking quite robust for us. We find, as I said, even within manufacturing, auto is not that strong, but most of the other segments in manufacturing are looking strong.
If you like this video, then like, share and subscribe to ET Now.